For the second consecutive quarter, we find ourselves saying, wow, what a difference just 3 months makes. Largely due to dovish or accommodative statements by the North American central banks, asset classes of all sorts, stocks, corporate bonds, government bonds as well, rallied very strongly in the first quarter of the new year. What was the economic backdrop to this situation? Looking first at Europe, the broader European economy showed very little change from the fourth quarter to the first. Germany's economic growth slowed slightly in the second half of 2018, but its unemployment situation appears to be quite strong into 2019. In contrast, Italy's economy continues to contract. In light of this situation, the European Central Bank, or ECB, kept its target short-term interest rate at 0%. If we cross the channel to the UK, we see that its path to Brexit is really no clearer now than it was 3 months ago. A late March deadline came, went, and it was extended to mid-April. But despite the high political drama and changing positions almost every day, Britain's economy didn't skip a beat in late 2018 and so far looks to be in decent form in 2019 as well. In light of this, the British Central Bank, the Bank of England, kept its target overnight interest rate at 0.75%, where it's been since last August. In the last quarter of 2018, Canada's economy slowed to a growth rate of only 0.4%, and new job creation also slowed as well. However, job growth perked up very strongly in January and appears to be reasonably strong in February and March as well. If we look at the longer-term 12-month figures, we see the two solitudes illustrated that have been present for the last several years. On the one hand, job creation in Alberta has been essentially flat for the last 12 months as the province deals with its oil patch travails. But in the rest of Canada, job creation is actually at record high levels. Similarly to Canada, the American economy slowed somewhat in the fourth quarter of 2018 to an annualized pace of 2.1%. However, U.S. job growth was quite strong into the new year. Its unemployment rate is close to a 40-year low, and its initial unemployment insurance claims, or UI claims, also remain just slightly above the record lows that they were at in middle 2018. In spite of what seems to be robust, healthy economic growth into the first quarter, both the American and the Canadian central banks made no change to the target interest rates. Both actually communicated instead that any subsequent increases will be at a slower pace than was previously thought and will be done with a great amount of caution. It seems that the central banks were spooked both by last year's fourth quarter sell-off of stocks and corporate bonds and also by the slight economic weakness that accompanied that sell-off. As we mentioned earlier, stock markets soared in the first quarter with returns of about 10% or even more. Corporate bonds also joined in the euphoria, and surprisingly, government bonds did as well. Bear in mind, the government bonds were rising in the last part of 2018 as stocks and corporate bonds were declining. After such a strong rally, the Canadian Universe Bond Index had a return of nearly 4% in the first quarter. However, bond rallies and low interest rates contain the seeds of their own future limitations. At the end of the quarter, for example, the yield or interest rate on a 10-year Government of Canada bond was barely 1.6%. Owing to the significant price increases across all the major asset classes, the Compass portfolio returns in the first quarter ranged from just over 4% for the most conservative to just under 10% for the most aggressive. The putative cause of the first quarter's financial market euphoria was the decision by the North American central banks to ease up and pause their interest rate hiking. However, it was always a given that the central banks were going to do this as interest rates approached a level that the bankers thought was neutral. In other words, the goal of the last 2 years' interest rate hikes was not to squelch inflation and slow the economy, because inflation was and still is well under control. Rather than trying to squelch inflation, the goal of the increases over the last couple of years, as stated numerous times by the central bankers themselves, was to gradually remove the excess monetary stimulus that was enacted in the wake of the 2008-2009 financial crisis and global recession. In other words, they're trying to wean the North American economy off the ultra-low interest rates of that time. Now that a healthy, significant part of those interest rate cuts have been retracted, it's really no surprise that the central banks are going to take things a little bit slower and wait and see how the economy has digested the previous interest rate increases. However, the view that's taken hold in some quarters that the central bank's next move is to cut interest rates is, in our opinion, misguided for at least a couple of reasons. First, the North American economy is reasonably healthy. It's certainly not sputtering, let alone collapsing. Secondly, interest rates weren't particularly high even at the start of the year and are even lower now. If as investors interest rates are low, that means they're equally low for borrowers, and monetary policy is just not very restrictive at this point. We have very little doubt that if the North American economy were to tip into recession, its central banks would lower interest rates. However, we also believe that if the North American economy continues to grow at a healthy clip, not necessarily a breakneck clip, but even just a healthy clip, that the central bankers will continue to raise interest rates, albeit at a somewhat slower pace than over the prior few years. So the importance and the virtue of patience in achieving long-term investment success simply can't be overstated. Just 3 months ago, many were rubbing their wrists with worry over the financial market decline. Our exact words at that time were, "Don't let the inevitable short-term gyrations distract you from your long-term journey to investment success." We take no credit for predicting a quick turnaround in financial markets in the first quarter of this year. We didn't make that prediction. We will take full credit for noting at the time that gyrations are just a natural part of financial markets and part and parcel of investing, that gyrations are best ignored, and that time and patience are your allies when running the investment marathon.